Hello, traders. Welcome to a new week of trading. My name is John Kickleiter. I'm Chief Strategist here at DailyFX.com. And we're here to talk about specifically the fundamentals that we are facing this week. And we will certainly wrap up on what the fundamentals were last week because that's where we get a lot of our carry through. And of course, themes that were important last week will certainly be more important this week as we develop those underlying currents. So, before I begin, just let me get a thumbs up or a yes so that I know that all the audio and visual are working. And if they are indeed, then I can dive right into the main themes that we should be looking at as traders this week. Just give me a yes or a Y in the right box there. Okay, excellent. Thank you, guys. All right. So the first thing that we're starting on, obviously, here is the U.S. dollar, the Dow Jones FXCM Dollar Index. Now, this was perhaps the most provocative move that we had last week. If you look at other measures or other benchmarks for activity, like the S&P 500 is a measure of risk, you really didn't have much in the way of follow-through one way or the other. Now, typically, we have seen a positive correlation between the two of these. It actually is a positive correlation today. But in the longer stretch of things, when we're talking about a U.S. dollar, all right, what does it really represent to global investors? Yes, there is a large economy there, and it does provide some standard of growth, but there's certainly a lot better rates of return to be had in other countries around the world, especially emerging markets. So it's not really the US dollar that we look to as our preferred investment. All right, that is much more an emerging markets. That is much more at this point European markets. That is much more Asian markets like China and its suppliers, like Australia. Australia being a large commodity exporter to China, who is dependent upon that Chinese growth. So there is a lot better rates of return out there. And in comparison, the US dollar is really a liquidity provider. Now, that standard has changed somewhat over time because we do know that in a extremely low interest rate world, all right, and low interest rates are exactly what we are looking at. In fact, here is the S&P 500 versus the yield, the rate of return, the benchmark or the baseline rate of return for the majors. So I have a risk reward index that I show every so often. All right, looks like that, the red line. Now, what does that reflect? That reflects this rate of return. All right, reward, as we call it, in oftentimes. And I just divide it by volatility or risk reward. All right, simple, most basic assessment of market appeal, and that is what it is. This yield, though, shows still that we are exceptionally low in terms of return, global return. And in these circumstances, the US dollar is actually not that unattractive because all of its counterparts are yielding very low rates of return as well. So it's actually pretty competitive. All right. Furthermore, we know that the US dollar has taken a significant tack towards tightening. Right? While it's very far away from that first rate hike, the Fed has instigated a tapering. All right? That is very different than what its global counterparts are doing. Take, for example, what's going on with the Euro USD. From a fundamental perspective, the Fed is tapering, but what is the ECB doing? They're actually contemplating further easing. That could be in the form of rate hikes, and there's even discussion that they could potentially do negative interest rates on deposit rates. They could even do a targeted stimulus program. While we haven't fulfilled those concerns or those options, they are still something that draws a significant contrast between the performance of the dollar, or the monetary policy outlook of the dollar, and the euro. Now, this draws in a concept that we have, two concepts actually, that we have to remain vigilant on. And we talk about this, we repeat this constantly. Risk trends is obviously one of them. And if risk trends start to really roll, all right, most of your asset classes are going to realign. We're going to see the dollar be treated as a safe haven. The yen is going to be treated somewhat as a safe haven. It's not really a safe haven. It's more of an deleveraged or unwound carry trade. You're going to see risky currencies like the euro, fundamentally risky, and the risky currencies as an investment currencies that people just need to get out of, like the Australian dollar, are going to be hurt. Okay, you're going to realign to that theme when that theme is important. I can't tell you how many people try to convince me that risk reward is no longer a theme. It's completely changed. The dollar is no longer a safe haven. It's not necessarily a safe haven right now because it's not necessary. All right, that's the important thing to assess whether we actually are in a risk reward themed world, and if we are, then we can start seeing those currencies play those roles. If we aren't, then we're going to be running under different circumstances. Okay, so when I look for the risk on, risk off theme, and I have been, because actually a trade that I took over the actually early Monday, early this morning, was the dollar yen. All right, and I'm looking for a potential deeper correction here. Now, as you can see, we have a big wave up, we have this wedge formation, and as I've said, and I've said it a number of times now, and even in this particular webinar, this has a lot of potential to continue to the upside. All right, plenty of open sky. Now, just because it has open sky does not mean it's going to advance. There is a strong fundamental reason why this can continue to the upside, and that can be seen in the second of the two themes. All right, and that is relative monetary policy. Now, relative monetary policy refers to essentially it's a nice word that means currency war. All right, central banks, a number of central banks out there, are attempting, whether they mean to or not, to lower the currency that represents their country. All right, what's the benefit of that? Well, if I am shipping my widgets that I produce here in my country to my trade partners, if my trade partners create widgets and their currency is much lower than mine, all right, they're going to sell a lot more widgets than me. But if my currency depreciates, I can keep my widgets at the same price and they will still be competitive. They will actually fly off the shelves because they'll be cheaper when I ship them over to the other country because of the exchange rate. All right? So there is a benefit in seeing my currency devalued. Now, some central banks are doing this on purpose, some are not. I think that there is little doubt that the Bank of Japan has taken this, at least in part, to devalue its currency. How do I know this? They admitted to as much, but they backtracked later on because they don't want to get in trouble by their international counterparts, who are very adamantly against, I don't want to say against manipulating their currency or exchange rates, but they're against saying they are. All right, I guess it's a very important distinction for policy officials. But nevertheless, the Bank of Japan is likely to continue to devalue its currency, and this is actually the dollar yen. All right, and this is the difference between the Fed's and the Bank of Japan's balance sheet. All right, there has been a severe contrast here because the Fed's QE3 program has been far more aggressive in terms of scale. Now, this is going to likely turn around, however, and support this move to the upside because the Fed is starting to taper, and we will see the next Fed taper in a couple of weeks. But the Bank of Japan is expected to move in on its second stimulus program. All right, they're expected to upgrade their open-ended stimulus program. So this is why I have been monitoring the performance of the dollar yen now heading into the second round of QE2 for BOJ. And this light blue or light purple line is starting actually on November 1st, 2012 and goes all the way up to the end of May 2013. This is April 4th, all right, of 2013. This was when the Bank of Japan actually announced their stimulus program. Big lead up into that. This purple line, darker purple line, is the current condition, November 1st, 2013 to present. you can see that we're tracking out the same track because we are under the same assumptions. Now, this is a very considerable catalyst for the dollar yen and all the yen crosses. There's a big stimulus program like there was last time. Perhaps there's a big rally. All right, it's easy for for traders and market participants in any capacity, whether I am trying to just take advantage of the exchange rate. Remember, not every person in the FX market is trying to just work the exchange rate. There's a lot of policy officials, a lot of bank managers, a lot of corporate managers who are just trying to secure the best exchange rate possible. If they expect the Bank of Japan to move in the future, let's say that this is a U.S. manufacturing branch that is trying to ship their goods to Japan. All right, would they want to do it now or would they want to do it later? Book the exchange rate. They want to do it later. All right, or sorry, if they're shipping, they want to do it later because they have to assess a current rate now and how much they can get for it and what they can get later. No, I said it again, wrong again. They want to do it now because their dollar is going to be able to purchase X number of yen, but at the same time, people are buying their goods. All right, so if the Japanese yen becomes depreciated, it's going to be more expensive to buy those U.S.-based goods, and they're net going to buy fewer of them. All right, so you have to. There are a lot of different means of being in the FX markets, not just speculative. All right, and the inference and implications of changes of monetary policy are exceptionally important. Exceptionally important. So this is actually, since we're already on this topic, this is a trade that I took here on dollar yen. There are two aspects, risk trends and the relative monetary policy aspects that I need to take into consideration with this. As of right now, the market's belief that the Bank of Japan is going to do a QE program, a second QE program, or realistically an upgrade to that QE program, is high. The problem is the actual rate decision or the timing that's expected with it is essentially exactly the same as last year. It's about April, one of the two April meetings. Why? Because April is the fiscal year end for Japan. All right, and in the fiscal year end, that's when we start to see the major changes like the tax hike that's expected in the country. This creates something of a necessity rather than just a response. They need to respond to something that will be very likely negative growth impact. All right. So in those assumptions and in that time frame, we know that there is likely to be a move, probably more closer to the April decision. In the meantime, are we just going to steadily advance like this, like we did in the lead up of the first round? Not necessarily. Right? Just because it looks pretty, and just because we have this wedge breakout and has all the elements that we like to see on a technical basis, does not necessarily mean it's going to run on a fundamental basis like that. All right. Very important to this aspect and very important to keeping this moving forward is risk trends. What is the dollar yen? What are the yen crosses in general? We only looked at the dollar yen, but here's the euro yen. There's that nice pattern there, if you want to call it head and shoulders. I'll be down with that. Pound yen, big pullback. Swiss yen, pullback. All right. Funny restraint on Aussie yen, and painful just does not want to break Kiwi yen. But they have seen pullbacks in the more provocative yen crosses. All right. These yen crosses are all, however, on a longer period of time frame, significantly higher. A lot of buildup in these trades. Now, what are people investing in here? Now, historically, we expect these yen crosses to provide a lot of carry. The yen is presumed to be the preferred funding currency of the FX market. The only problem, we don't have carry. There just isn't any carry. I show this chart well enough, or often enough. This is Aussie yen and its yield differential. Bit of a gap there. Historically, this is extremely low in carry. Dollar yen, extremely low in carry. There isn't really carry to be had. All right. Yet, where are these yen crosses in relationship to where they have been historically? They're at multi-year highs, or just off of it. All right. That's a very big contrast. The presumption is that the Bank of Japan is devaluing the currency, so the yen should continue to depreciate. However, what happens when these positions, which are no doubt built upon leverage — I know I'm using some leverage, I know other people are using leverage — these positions that are built upon leverage and on the foundations, on the expectations that volatility will remain exceptionally low, what happens if volatility starts to pick up? And volatility starts to pick up when we start to talk about fear, right? The volatility indexes, whether you're looking at the equities, the FX market, commodities, treasury yields, emerging markets, volatility is a measure of fear or uncertainty. Okay? And that's why it has a pretty straightforward impact when we're talking about the S&P 500. Here you have the S&P 500 versus the VIX upside down. All right. The correlation is pretty good, actually, and for good reason. This is directionally biased. The S&P 500 typically rises, and volatility will typically fall. When that volatility or uncertainty rises, or as it would in this graph, drop, so would the S&P 500. Right? The same thing is going to happen to carry trades. People will unwind carry trades when we see a bout of fear, of volatility, because we're not going to make any carry. You're not collecting a lot of carry being long a yen cross, knowing that if there is a drop of any kind of magnitude, it'll easily wipe out that carry. Okay, so it's a transitional aspect on these yen crosses. And what I initially had seen in the dollar yen is actually not necessarily risk. It is much more the dollar's pullback. In the dollar's pullback, we see the dollar weakening against most of its counterparts. The dollar yen being one important one that had this nice technical pattern here. So I like to combine my technicals and fundamentals. All right, so we had that tentative break. Now, to carry it further, yes, the dollar depreciation can forge some momentum behind this, but realistically, the true momentum behind these yen crosses would be seeing something like the euro yen and the pound yen and the Swiss yen and all these other yen crosses dropping aggressively. All right, you're going to get a lot more leverage or amplitude out of a yen cross deleverage than you would a dollar sell-off. All right, the dollar is going to be difficult to maintain its momentum to the downside. We'll talk about that next, but it's pretty easy actually to start a fire when it comes to risk aversion. All right. Exceptionally exposed risk aversion. At the end of last week, I whether we're talking about my strategy video, my weekend video, or my section in the euro section of the Trader Fade file, or the weekly trading forecast file, I voiced some significant concerns. And my concerns were really in terms of how complacent the markets have been. Now, it's not anything new. We know that these markets have been complacent. But my real concern is extraordinary lengths of this complacency. Here we have realized volatility. All right, realized just means historical. Compared to something when we look at the VIX, this is implied or expected volatility into the future. All right, this is actual volatility from what we've gotten in terms of price action and how the markets have priced. You can see that anytime I have the light blue highlights here, that's when it's below 10% on a 60-day basis. That is a 3-month rolling basis. This is extraordinarily quiet. All right, this is extraordinarily quiet. Now, the funny thing about, not funny, but it's practical, but you also have from volatility a reflection of the costs of a hedge. All right, options are often used as hedge or protection, and you can see how much that protection costs through implied volatility or actual volatility as well. It's so cheap for this protection because so little interest is to be had in it. All right, and it has been unnecessary to this point. Now, historically, we have seen that very extraordinarily lows in these realized volatility measures have turned into corrections, meaningful corrections. But recently, the past two have only been mild or short-term corrections. We are once again at that extreme low, and the question is whether we have a more dramatic decline. All right. We know that we have this extraordinarily low level of volatility or assumption of risk, not just realized but also expected. All right. We know that participation is exceptionally low. Participation is extremely important. Extremely important. All right. If you're planning on seeing a bull trend, you're not going to go very far if you only have two people buying up the market because they only have limited capacity. You need to have market depth to continue. The same thing is true of a reversal. This is particularly true of a reversal. If you're going to see a trend that counters the prevailing theme or the prevailing current, which is bullish, you're going to need to see some pretty remarkable participation. You're going to have to see a lot of people unwinding their longs, selling off their positions. All right. That's why we have a relatively strong relationship when it comes to volatility and volume or participation. And once again, this is on the S&P 500. Now, what can get these markets moving? Well, compared to December, this is actually the S&P 500's average monthly performance and average monthly volume from 1990 to current. And as we were talking about, and it played out pretty well actually, December is the strongest month of the year on average. I don't think it was the strongest month, but it certainly was a strong month this past December. And volume was the lowest of the months, and that was indeed the case. January is materially weaker and volume materially higher. We haven't seen that volume pick up in a meaningful way yet. In fact, I have been keeping track. Okay. Let's see, where's my volume? Here we go. Volume. All right. Comparing volumes for January, going back the past 10 years. Black is our current year. And as you can see, our volume is exceptionally low. The only lower volume that we have here is 2013 and 2009. 2009 ended up being a very aggressive sell-off into the first quarter, or actually it was a pause and then continuation. And 2013 was a slow and steady advance. Okay, these levels of activity are incredibly important to the ability of these markets to drive forward or reverse. And remember, risk trends in general are important for most of our currency pairs, but they're nowhere more important than when it comes to the yen crosses, which are a carry trade and which are facing the expected forecasts of a Bank of Japan stimulus program. All right, that stimulus program is fixed. All right, we see it like a star in the distance. We know that it's eventually we're going to get there, but how long will it take? All right, when will the market see something that distracts them on the way to their or from their focus? And if we do, what can do that? Risk trends. Trends can do that. Now the question is whether we can stir risk trends this week. All right. I think that there were a couple of things that were exceptionally important over the past couple of weeks, or 3 or 4 weeks, that could have stirred risk trends. Most notably, the December taper. All right, the Federal Reserve tapered its monetary policy program for the first time, a surprise for most. All right, and we know that the S&P 500 has held a meaningful relationship when it comes to monetary policy. Now, of course, there are many central banks out there. In fact, I keep the relative stimulus programs, or all the stimulus programs, aggregated, at least for the Fed, ECB, Bank of England, S&B, People's Bank of Japan, and the Bank of Japan, or sorry, the Bank of Japan and the People's Bank of China. And this is the total stimulus program, and certainly continues to rise. But when we're talking about the symbolic leader of monetary policy, the one that started it all, and the one that started it all on large scale, that's where we're talking about the S&P 500, all right, and the Fed. The Fed was the first, and the Fed was the biggest. The fact that they're starting to taper is disconcerting. Disconcerting for a market that has catered more towards exceptionally low volatility. All right, and the assumption is that that volatility would remain exceptionally low, rather than, let me see this, rather than rates of return, getting back to the kind of investing conditions that we saw prior to 2008. Right? This is the FX volatility index flipped upside down. We've grown more accustomed to low volatility than we have to exceptionally low rates of return. This is why we have seen participation so low. This is why the market is using exceptional leverage, because it knows it doesn't have yield that can make these investments worthwhile. So we have to go into extremely risky assets, like high yield assets in emerging markets, and we have to use leverage, because we don't have the rates of return naturally that we would have 4 or 5 years ago. All right. So this becomes a very risky proposition. This is like musical chairs. Keep it going as long as the music's going. And once the music's going, you better hope that you can get out, because it's probably going to be quite aggressive. Because when you have leverage of this magnitude and you don't have enough cash, the actual cash level to cover potential margin calls is actually the lowest we've seen in a very long time. Might even be a record. I cannot recall. All right. So those are the circumstances we must avoid, we must watch for. These are risks, very material risks. And when the Fed starts to back out of that stimulus program, it means that there is a possibility that the relationship that we have between monetary policy and volatility could very well start to deviate. See, a lot of people have a problem with my associating total stimulus to risk-taking. Right? I think that the correlation is actually quite strong, or the relationship, not the mathematical correlation, which is pretty strong, but the fundamental relationship is quite strong in my book. But if you have a difficulty of making that gap, filling that mental gap, then I can very easily make an argument that stimulus actually lowers the assumption of risk, the presumption of risk. When you see stimulus, there is an effort to put more capital into the financial system, and subsequently it lowers the risk that individuals take, because the central banks are taking some of that risk on themselves, and they are saying that if there is adverse market conditions, we will step in and help stabilize the market. That's exactly what the ECB, for example, has done with its LTRO programs back in 2011, 2012. All right, so that lowers volatility. Well, as it happens, volatility is exceptionally important when it comes to the performance of capital markets. If I don't think I'm taking a lot of risk, or I don't see a lot of risk in a position, and it offers me some greater level of return, I take it. All right? There's a relationship there. So these risk themes can be stirred directly by monetary policy, and the Fed is already starting to pull back. Now, we're not going to get the next Fed rate decision for a couple of weeks now. All right? So that's not going to be a proactive catalyst. This past week, we had non-farm payrolls, which came out to be quite the negative surprise. In fact, the outcome of that NFPs for December was the biggest negative surprise since November of 2008. Not a good comparison to have, but that was a very significant decline. Nevertheless, what does the Fed look at? It looks at the unemployment rate. All right, and the unemployment rate actually dropped below 7%. 7%, if you recall back in June, when Bernanke, in the press conference that followed that June rate decision, said that they were expecting to begin their taper in later 2013. They did. And to end their QE3 program sometime mid-2014. And they presumed at that time that the unemployment rate would be around 7%, right below that 7% threshold. Now, of course, there are issues with this. All right, one of the reasons that we actually have the unemployment rate drop is because the participation rate is so low. People are just dropping out of the job market because they're so frustrated about not being able to find a job. This makes this data somewhat warped, right? And to many people, it's unreliable. That might be the case, but if the Fed is going to make policy decisions on this data, doesn't matter if it's flawed. They can, they could make rate decisions based on the color of the bananas they have for breakfast. If that were the case, I would definitely be doing my banana studies. It doesn't matter. It doesn't matter if we disagree with the data. It matters what the Fed does. All right. That's why we spend so much time looking over their commentary and kind of breaking down what their assumptions are and their forecasts are, because we have to find what they are leaning towards, because they're the ones that are making the rate decisions. All right, and if their stimulus is reduced because of decisions they make, then the relationship is going to be quite clear in the markets. All right. So with those non-farm payrolls, it was certainly a disappointing outcome from the non-farm payrolls report, but the unemployment rate, as dubious as it is, does continue to push towards the taper. Now, in reality, you have to consider that the presumptions before were that the Fed would keep their QE3 program running at $85 billion per month for the foreseeable future. And the burden was that they had to see something materially different before they could start considering the taper. Now those roles have reversed. Now they are starting to taper, and to stop that pace of tapering, they need to see something materially different to discourage the taper. Why? Because now they're talking exactly what we were talking about 3 months ago. The costs. There are costs to tapering. Or sorry, not tapering. To doing QE3 ad nauseum through the unforeseen future. All right? And one of the greatest risks that you have posed with unchecked QE is that you have driven markets' assumptions far too dramatically. They skewed them to encourage excessive risk-taking, excessive where leverage has been ramped up. All right? And now you're starting to see that the negative impacts from this QE are starting to match, or if not are greater than the positive outcome that they prevail. All right? So now the Fed is on a very different path, and that can certainly underscore and discourage risk-taking. A very risky condition going forward. Very risky. And when I pair that to something like my concerns with the level of expected volatility, the level of realized volatility, that just tells me complacency is way too low, and I'm severely concerned. All right? On the other hand, you also have a second aspect of this, relative monetary policy. All right? Relative monetary policy is exceptionally important, because when you see a Fed balance sheet rising more aggressively than its counterparts, the dollar will be more encouraged to decline against its counterparts. But if you see the Fed starting to taper, and let's say some other central banks are starting to ramp up, then we have a very different aspect where the dollar can regain some traction. This is nowhere more prominent than the dollar-yen. However, as we said, we have a rate decision out in April likely. In the meantime, you have 3 months before that upgrade to QE. Can the yen crosses remain stable enough in the light of potential volatility, especially if we have a risk aversion theme to keep up. They might not. Risk aversion kicks in, these yen crosses are going to come collapsing. All right. There's also pairs like the Euro USD, the Pound USD, even the Aussie USD, who have relative monetary policy aspects behind them. And that was the whole reasoning for my making this chart. Now, if you want to learn more about this, I actually made a complete video last week in the Forex strategy sections about this. This is a relative monetary policy standing chart, all right? And it's not what they're actually doing. The Bank of England is not more hawkish, or doesn't have a higher interest rate than the RBA, for example. It's the market's presumptions of what they are going to do next, all right? The market's presumptions are that the Bank of England is going to hike sometime in 2014, all right? It actually has shifted that far forward. Well, the Bank of England has said quite explicitly that we plan on holding it until 2015. So the market is more hawkish than the Bank of England, and even the Bank of England's time frame was relatively hawkish compared to many of its counterparts, like the Bank of Japan, like the Fed. All right? So it is at an extreme end of this hawkishness, and that is also why we have seen the pound run so aggressively. Obviously, it shows pretty prominently here in the pound dollar, but it's run so aggressively on the euro pound. It's run so well even against high yield currencies like the pound kiwi for the past 6 months because of those presumptions. All right, but how long can you continue running like this without tangible confirmation? All right, that's the concern. And that's why we're starting to see this pullback here. Pound dollar, if it gets below 162.50, I'm really going to be interested in it. First from a technical basis, but from a fundamental basis, this can also be the pound pulling back under its own weight because of those excessive interest rate expectations. If they come back to the ground, what else do you think is holding up the pound? Yes, underlying growth is definitely holding up the pound, but it's those interest rate expectations that have really given it amplitude. You undercut those, and you're going to start to see the pound falling. All right, we'll look at data for the different currencies in just a second to watch out for, but that's going to be a major one. The ECB, all right, they actually cut their benchmark lending rate back in November. Now the conversation is leading into possible new stimulus programs, a negative interest rate, negative deposit rate. Those are very dovish considerations. Yet, last week, the ECB decided to avoid any kind of commitment to a new stimulus program, and they certainly didn't offer a new stimulus program. All right, so that takes some of the pressure off of the euro in the immediate term. It still exists, but it takes some of that pressure off. So that makes the euro USD less attractive, in my opinion. All right, so I'm not looking at any imminent trades necessarily from the euro dollar's perspective. It has also tempered my appeal for the euro yen. So as the past last week and obviously the week before the holiday, I was talking about the euro yen and how I favor it over the dollar yen because of, in part, the expectations for the ECB. If they start to realize an expansion of monetary policy while the Fed is on its taper regime, obviously we would think that the euro yen is the more attractive short. All right, because not only would you have a possibility of risk aversion, where the yen crosses are generally unwinding, but you also have committed or concerted euro selling. But as we saw with the ECB last week in holding, you're not really going to feed that drive just yet. All right, so the market can still get to that belief, but they're not going to get it from the ECB. All right, so that tempered my appeal to that currency. How about the Australian dollar? We were talking about how this was an attractive one if it got above 90. It did indeed. I'm not long here because part of my concern with other pairs is that we have risk aversion. While this has separated itself from general risk themes, if risk aversion does truly kick in, this is going to probably take a hit too. All right? Even though it's already oversold, even though it is recently the correlation has dropped pretty significantly. Once risk trends start to pick up, once wind gets into those sails, it's very hard to shake it. All right, but when you look at the RBA, those interest rate expectations are already substantially low. All right, they're just off the end of a rate cut regime. There's still lingering threats from the RBA that they can cut even further, and that has put us on the extreme dovish end of that scale. But realistically speaking, 1 year from now, are they more likely to have hiked or cut? 1 year from now. Maybe 3 months from now, if the Chinese growth engine continues to slow down, we get another cut. But 12 months from now, you're more likely to see a hike than a cut. And those interest rate expectations have not necessarily been priced in, like they have been for the RBNZ, who has been talking about hikes for some time now. That means that we have much more room to gain on this scale, and that means, fundamentally, the Aussie dollar is substantially oversold fundamentally. All right, as long as we're talking about monetary policy as a scale. So there's room to gain here, but there is also, given that this is an Aussie USD, exceptional exposure to risk trends. All right, this is where these big fundamental themes conflict. Yes, this can gain on the relative monetary policy aspect, but what about risk trends? This is too great of a concern to go on that relative monetary policy theme. The same can be said with the Aussie yen. All right, but another trade that I have, and I actually took the first half of my profit because I hit the target. Euro Aussie. All right, that pits a euro where the interest rate forecast is starting to temper, though we haven't got that ECB confirmation yet. It's still starting to temper. The Aussie dollar, on the other hand, is a higher yield and is starting to round out the bottom of that curve. All right, so combined, this is a better short. So these are the aspects we should be continuing to look at. I am growing more and more concerned about the risk theme, but relative monetary policy is still a fundamental theme that is playing out. All right, and that's probably going to be your more active theme. So I'm watching pairs like the dollar yen now, which I have a short on. Now, in terms of the scheduled event risk that we're going to be watching for this opening session, was pretty light for the major themes, but there were some noteworthy pieces of event risk. We start to get into some more dramatic things, the things they can tap into monetary policy expectations and even potentially risk trends, though that risk trend theme is very difficult to spark on one indicator alone. But I would say watch the Japanese data this evening, Tuesday morning, particularly the trade figures, because that's going to tell you how the exchange rate is helping out the economy, and if it's not helping out enough, maybe the Bank of Japan will be encouraged to act a little bit more aggressively. For those interest rate expectations for the UK, CPI, PPI, RPI, the ONS, housing inflation, these are all very important inflation reports, and inflation expectations or current inflation rates are incredibly important for them to set monetary policy. So if you have hope that the Bank of England is going to hike sometime in 2014, you better see something out of these inflation figures that support that pressure will be picking up substantially. If these drop, that is significantly going to undercut those rate expectations. You undercut those rate expectations, keep a close eye on the pound dollar, pound yen, euro pound, all right, pound Swiss, pound Kiwi, pound Aussie. We have French President Hollande is going to give his 2014 agenda. That's going to be important tomorrow morning. I like to highlight this regularly because it is important. Small business confidence, the NFIB. This report is measuring a very particular group of businesses in the United States, but this is the group of businesses that do most of the hiring in the United States. All right, so obviously very important. Earnings season is also starting. I don't think it hasn't been a major mover over the past 6 quarters, but this can very quickly become justification for something that's already an expectation, like risk aversion. So be careful. We have Trichet speaking on the performance of the Troika. All right, he can at any time drop some kind of commentary that relates to monetary policy, so it's at least worth our watching or looking at the highlights. Of course, we'll also be looking at the policy speakers from the Fed. It just so happens that both of the people that we have tomorrow are voters, which is an important distinction, and they are hawks, which is an even more important distinction. All right, so that's going to be important. We're going to have growth forecasts from the World Bank, noteworthy for longer-term expectations and benchmarking those expectations. All right, we have Governor Carney from the Bank of England testifying to the UK Parliament. All right, so that's going to be noteworthy. Once again, monetary policy related. You have more Fed speakers. All right, Thursday we get into some more data, like economic confidence figures. These are from Bloomberg. I think they're pretty worthwhile, these economic surveys. We also have the ECB survey. All right. We have US CPI. That, if we're talking about a taper, taper from the Fed, you want to see the costs level of the margin, or side of the margin, rise, while the benefits declines. This CPI is going to be one of the costs aspects. All right? So we want to see if that does support. Of course, we also have Bernanke on Thursday, as well as a update for capital flows through November. And then through Friday, we're going to talk about U.S. consumer confidence. We're going to have another Fed speaker, and we're going to have some noteworthy European data, including bad loans out of Spain. There's been a lot of complacency on the instability of some of these European countries, including Spain, including Greece, and even those that are starting to emerge from their troika bailouts. Ireland and Portugal are exceptionally exposed in this exit. The ECB is actually going to be encouraged to make proactive, preemptive moves to prevent another crisis, because can you imagine the sentiment surrounding the Eurozone if one of the bailed out countries that emerges in such a successful story has to go back under? All right, that would be severely detrimental to general assessment of the Eurozone. So this data we have to watch. All right, doesn't require us to be active traders on individual pieces of data like this, but this is certainly important for our expectations. All right. So this data on the week is not necessarily filled with non-farm payrolls or Fed rate decision like data. All right. It's not going to be a market mover on the individual indicators. It's going to tap into the bigger themes. All right. And those themes are what we need to watch, because as we have seen, risk complacency has grown quite extreme, but so too have monetary policy expectations. All right. These differentials are going to be probably the more proactive mover, but you can never write off the possibility of general risk trends. It's very important that we assess both sides of this ledger, because those are two very market-moving possibilities. All right. I will be doing my Q&A tomorrow. All right, so you can ask all trading, market, and strategy-based questions you want in the Q&A back in Daily FX Plus tomorrow. If you don't have a login to that, I encourage you to do so. You can get it for free. If you are a FXCM account holder, you can also simply sign up for it individually. Of course, at that point, it's going to cost you, but there are two options for you. Come join me there. You can ask all questions, and obviously I'm not the only analyst back there answering questions. We have essentially all the analysts running Q&As at some point in the week. We also have a ton of educational content. We have the SSI updated regularly. We have automated strategies and tons of other considerations. All right. So come and join me tomorrow. It'll be 7 p.m. Eastern Standard Time. I'll be answering questions. Come in a little bit early. Ask your questions early, because I take them first come, first serve. And I like to open up the room a little bit early so that people can log their questions and just sit back and watch as I answer them as we go. But I'm there to answer all your beginner questions, advanced questions, and sometimes people ask me questions that I can't even answer. Doesn't happen often, but it does happen. So hopefully I get to see you guys there tomorrow. In the meantime, be very careful of these markets. Trade them with the prevailing theme, but be very careful when things start to change. Good luck trading out there, guys, and we'll talk once again in this particular forum next week.